America's debt spiral is now beyond control. The signs are unmistakable, and they're accelerating faster than anyone expected. When a nation as powerful and influential as the United States begins drifting toward an unsustainable fiscal trajectory, it's not a local issue, it's a global shockwave in the making. What we're witnessing today isn't just another cycle of deficits or political disagreements about spending. It's a structural breakdown in economic discipline that has unfolded quietly for years but is now impossible to ignore. Debt levels aren't simply rising, they're compounding. Every year of delay magnifies the pressure on future taxpayers, future policymakers, and future innovators. And the most concerning part is how normalized this escalation has become. Markets see it, economists warn about it, yet the system continues moving in the same direction, almost as if it has no brakes left to pull. When debt accelerates faster than economic growth, it becomes a gravitational force. It pulls resources away from innovation, away from infrastructure, away from the investments that historically drove American leadership. Instead of empowering the next generation economy, AI, robotics, energy transformation, biotechnology capital increasingly flows toward interest payments. Money isn't being used to build, it's being used to service yesterday's obligations. This is where the spiral becomes dangerous. The cost of borrowing rises as confidence weakens. Investors who once viewed U.S. Treasury bonds as the ultimate safe haven start demanding higher yields, not because they doubt America's ability to repay, but because they can see an imbalance forming between debt growth and economic output. The world's largest economy cannot expand sustainably while carrying a burden that grows faster than its own productive capacity. And when interest becomes one of the largest federal expenditures, surpassing areas that actually drive growth, you're no longer dealing with a manageable challenge, you're confronting a structural flaw. Every dollar consumed by interest reduces flexibility, reduces investment, and reduces resilience. It leaves the system more fragile in the face of shocks, whether they come from financial markets, geopolitical shifts, or technological disruptions. This is why the debt spiral is so alarming. It isn't about politics, it's about mathematics, it's about momentum. Once a nation crosses a certain threshold, reversing the trajectory requires not small adjustments, but profound rethinking. The United States is now at that stage, a point where conventional solutions won't be enough, a point where future strategies must be transformative, not incremental. The question now is not whether the debt is large, everyone knows that. The real question is whether the country can realign its economic priorities in time. Because the longer the debt expands beyond control, the harder it becomes to invest in what actually produces growth. And growth isn't optional. It's the fuel behind every innovation, every job, every technological breakthrough that reshapes the world. True leadership requires acknowledging that the old frameworks no longer work. The global economy is shifting toward technological acceleration at unprecedented speed. AI, automation, clean energy transitions, and decentralized systems are redefining how nations compete. But no country can fully capitalize on these shifts while dragging a financial anchor behind it. America still possesses unmatched innovation capacity, entrepreneurial depth, and technological leadership, but even the strongest engines slow when they're overloaded. The debt spiral must be understood for what it is, a constraint on future potential. A warning that the window for correction is narrowing, a signal that urgency is no longer optional. The future will belong to nations that invest aggressively in innovation, not in interest payments. And the path forward, if chosen wisely, can redirect momentum toward growth rather than gravity. The debt spiral may be beyond control in its current trajectory, but the future is never predetermined. What matters now is awareness, clarity, and the courage to act before the window closes. The U.S. debt crisis has entered the point of no return. There are moments in economic history when the data becomes so overwhelming, so unignorable, that it forces a reckoning. Today, the United States is standing exactly at that crossroads. The debt crisis is no longer a distant forecast or a theoretical concern discussed quietly in policy circles. It has moved into a new phase, one where momentum has overtaken management, and the system is drifting toward outcomes that were once considered unthinkable. The country has entered a point where traditional tools, traditional politics, and traditional assumptions are no longer enough to stabilize the trajectory. The numbers alone reveal the severity of this turning point. Debt is expanding faster than revenue, faster than GDP, and faster than any structural reforms that policymakers attempt to implement. This pace isn't just unsustainable, it's structurally dangerous. As the debt load grows, so does the cost of servicing it, and that cost is rising at an exponential rate because interest rates are no longer near zero. Borrowing has moved into a new era where every additional dollar of debt carries a heavier long-term cost. This is where the crisis becomes self-perpetuating. Higher interest expenses consume more of the federal budget, leaving fewer resources for priorities that actually stimulate growth, research, innovation, infrastructure, and emerging technologies. Instead of building the economy of tomorrow, capital is increasingly diverted to pay for decisions of the past. This imbalance is what defines the point of no return. It is the moment when debt stops being a tool and starts becoming an anchor. Over time, this anchor begins to weigh on the entire system. Investors see the trends. Global markets see the trajectory. Confidence doesn't collapse overnight, but it erodes gradually, invisibly, until one day yields spike, volatility rises, and the structural weakness becomes evident to everyone at once. Financial crises rarely begin with a dramatic event. They begin with ignored numbers, postponed decisions, and chronic imbalances that eventually hit a critical threshold. What makes the current situation particularly concerning is that the U.S. is facing this crisis at a time when innovation is accelerating globally. The world is entering a new technological cycle defined by artificial intelligence, robotics, decentralized finance, and energy transformation. These are areas where aggressive investment is essential to remain competitive. Yet, the fiscal pressure created by the debt crisis limits the nation's ability to fully seize these opportunities. When debt grows faster than innovation, the result isn't just economic stagnation, it is global repositioning. This is the real consequence of reaching the point of no return. It is not about default or collapse, it is about losing the ability to lead. The greatest risk is not financial implosion, but strategic decline. A country burdened by debt cannot move quickly, cannot invest boldly, and cannot maintain the agility required in an era defined by exponential technological change. The future will not wait for nations encumbered by old obligations, yet the situation is not hopeless. It simply requires a recognition of reality. The old assumptions that debt can grow indefinitely, that interest rates will stay low forever, that fiscal imbalances can be patched later no longer apply. The new environment demands a shift from complacency to innovation-driven urgency. The only path forward lies in generating growth at a pace that outperforms the expanding debt burden, and that growth can only come from transformative technologies, disruptive industries, and bold strategic investments. The moment we are in should be understood clearly. The U.S. has crossed into a phase where delaying decisions is more dangerous than making the wrong ones. The debt crisis has entered the point of no return because the system now moves faster than the policymakers who try to control it. What remains is the opportunity to redirect momentum, not by trimming at the margins, but by doubling down on the forces that create exponential value. The era ahead will reward nations that adapt with speed, clarity, and conviction. Those who hesitate will be constrained by the weight of their past, America can't escape this debt trap. Here's the truth: there comes a moment when numbers stop being abstract and start becoming signals, hard, undeniable indicators of a system pushed beyond its limits. America has reached that moment. The debt trap is no longer a risk, a warning, or a potential scenario. It is a reality shaping every economic decision, every market reaction, and every future projection. And the truth is simple: the country can't escape this trap without fundamentally rethinking how growth, innovation, and fiscal discipline intersect. This isn't just about trillions of dollars on a federal ledger. It's about a structural pattern that tightens with every passing year. Debt is rising faster than the economy can expand, faster than revenues can catch up, and faster than policymakers can respond. When debt outpaces growth consistently, it creates a gravitational pull, a force that diverts resources away from productive investment and toward maintaining obligations that no longer generate value. That's when the trap begins to form, slowly at first, then rapidly. America is now in that rapid stage. Interest payments, once a minor budget line, are exploding. They're consuming a larger share of federal spending than ever before. When interest becomes one of the biggest expenses of a nation, it signals a deeper issue. The past is borrowing from the future at a pace that the future can't sustain. And once interest grows faster than investment, a country loses the flexibility it needs to innovate, adapt, and compete. The danger isn't just mathematical, it's strategic. While America is caught in this tightening debt cycle, the world is entering a new technological era. Artificial intelligence, robotics, energy storage, and genomic breakthroughs are reshaping global power dynamics. Nations that invest aggressively in these sectors will lead the next century, but nations weighed down by debt will struggle to commit resources to these transformative fields. The trap becomes more than a financial burden, it becomes a constraint on national potential. This is where the truth becomes unavoidable. Escaping the debt trap isn't about cutting a few programs or raising a few taxes. Those are linear solutions for an exponential problem. The debt is compounding. The costs are compounding. The risks are compounding. Linear adjustments won't change the trajectory. The country needs exponential growth, and exponential growth only comes from breakthrough innovation, not incremental policy shifts. Yet innovation demands investment, bold, upfront, long-term investment. It requires capital that isn't tied up in servicing interest obligations. It requires a system that rewards risks taking, not one that is dragged down by the weight of old liabilities. This is why the debt trap is so dangerous. It not only consumes financial resources, but also restricts strategic vision. It forces the country to allocate capital to survival rather than leadership. Politicians often talk about fiscal responsibility as if it's merely accounting. But in reality, fiscal health is directly connected to innovation capacity. A nation drowning in debt isn't just financially compromised, it's technologically slowed, competitively weakened, and strategically vulnerable. The debt trap suppresses the very forces needed to escape it. That's the paradox America faces today, but within every trap, there is a turning point, a moment when clarity forces change. The truth is that America still has extraordinary advantages: a culture of innovation, the world's most dynamic entrepreneurs, and a technological ecosystem unmatched anywhere on the planet. What's missing is not capability or talent, but prioritization. The country must decide whether it wants to continue financing the past or unleash the future, because the resources cannot do both. Escaping the debt trap won't come from austerity or wishful thinking. It will come from doubling down on innovation so powerful that it outgrows the weight of the debt. Exponential transformation is the only path forward and the only force strong enough to break the gravitational pull of compounding obligations. The truth is clear: America can escape this trap only if it chooses to rebuild its economic engine around the industries that define the next era of global leadership. The unspoken financial meltdown. America's debt is unstoppable. There is a point in every economic cycle where the truth becomes too large to ignore, yet too uncomfortable for most to say out loud. America has reached that exact moment. The financial system is still functioning, markets are still trading, and the headlines still highlight optimism, but beneath the surface, the debt machinery is accelerating at a pace that signals something deeper, something structural, something dangerously close to irreversible. This is the unspoken meltdown, a debt trajectory that is no longer slowing, no longer stabilizing, and no longer within the boundaries of conventional control. The most revealing aspect of this crisis is how quietly it has unfolded. There was no single collapse, no dramatic turning point, no historic announcement. Instead, it was a gradual erosion, a slow but relentless buildup of obligations that compounded through decades of decisions driven by short-term thinking. As a result, debt has grown faster than revenue, faster than productivity, and faster than the nation's economic capacity to sustain it. The numbers alone don't just suggest a problem. They signal a system operating far outside its safety margins. This is why the situation looks unstoppable today. Every year, the debt grows exponentially, not linearly. Compounding has taken over. The interest payments, which were once manageable, have now transformed into one of the largest expenses in the federal budget. When interest becomes a core expenditure, it reveals an economy forced to prioritize the past instead of investing in the future. That is the defining mark of a financial system in silent crisis. The danger becomes even clearer when you examine what is being sacrificed. Dollars that should be driving innovation, scaling breakthrough technologies, advancing scientific research, or transforming outdated infrastructure are instead being diverted towards servicing old debt. This is not just inefficient, it's strategically devastating. The global economy is moving into its most transformative era, one shaped by artificial intelligence, multidimensional automation, synthetic biology, precision manufacturing, and new forms of energy architecture. These are sectors where leadership is determined by bold investment and rapid acceleration. But a nation weighed down by compounding debt cannot respond with boldness. It responds with caution, hesitation, and delay. That drag creates the real meltdown, a long-term competitive decline disguised as fiscal imbalance. When a country can't invest aggressively in the industries that define the next century, it surrenders leadership by default. And leadership loss in a technology-driven era is far more damaging than any recession or market correction. It reshapes global power, supply chain influence, intellectual property dominance, and the ability to set economic standards for the rest of the world. This is why the debt crisis is not merely an accounting issue. It is a strategic crisis, a security crisis, a technological crisis. The real meltdown is not the risk of default, it's the erosion of future potential. The unsettling truth is that the system, as currently designed, cannot reverse this trajectory. Incremental changes won't matter, budget negotiations won't matter, minor shifts in spending priorities won't matter. When debt grows exponentially, solutions must grow exponentially too. But the political and fiscal frameworks in place today are still operating with linear tools. That mismatch is the very reason the debt is now described as unstoppable. Yet, even in this quiet crisis, there exists a window for transformation. America still has unmatched intellectual capital, the world's most powerful innovation engines, and a private sector capable of scaling revolutionary technologies faster than any nation in history. But the country must shift from a system where debt dictates decisions to one where innovation dictates direction. Only exponential growth driven by technologies capable of reshaping entire industries can counteract the gravitational force of compounding debt. The unspoken meltdown is real, but so is the potential for renewal. The question now is whether the nation will recognize the urgency before the weight of the debt makes the choice for them.